Hello, and welcome to our channel. Today, in this video, we will talk about the Bollinger Bands. 1. What are Bollinger Bands? 2. Where are they used? 3. How can you create Bollinger Bands from scratch in R? If this is of interest to you, then keep watching. Note that this video is not about how to do trading. Bollinger Bands are used for technical analysis in the financial trading such as share trading, currency trading or commodity trading. They were developed by John A. Bollinger. John Bollinger is an American author and financial analyst. He also wrote a famous book called Bollinger on Bollinger Bands in year 2001. Since then, this book has been translated into 11 languages. We will be using these packages. To install packages in RStudio, click on the Packages tab. Enter the name of the package and click on Install. Here is the command to get the historical gold prices. We are using the QuantMod package to download this data. You can only get the last 180 days of data. So you can set the from date and to date as per your needs. Now convert the data into a data frame. Then add a date column. Before we go any further with our coding, let's first get our drawing board out to see what actually are Bollinger Bands. A Bollinger Band has 3 lines. First line is a 20-day simple moving average of a security's price, and then second line is 2 standard deviations above the simple moving average. The third line is 2 standard deviations below to simple moving average. You can obviously create Bollinger Bands for any number of days, but generally 20-day is used. In this example, we are using 20 days simple moving average and also the 20-day rolling standard deviation. We will elaborate on this more in the next section. Bollinger Bands provide signals for the overbought or oversold conditions for a security. When the price touches the upper Bollinger Band or goes above the upper Bollinger line, then the security is considered overbought. That means lots of people have bought the security, and the analysts will be hoping for a downward trends in the near future. On the other hand, if the security price goes below or touches the lower Bollinger line, then the security is considered oversold. Which means that a lot of people might have short sold the security. And in order to close their trades, they will need to buy the security in the near future, which eventually will lead to more demand and thus an upward trend on the price. Squeeze is a critical concept of Bollinger Bands. When the Bollinger Band come very close to each other, and the envelope becomes very narrow. This indicates that the prices of the security are staying in a narrow range. And there is less volatility in the prices. The traders believe that trading opportunity will soon arise, as in the near future they expect a period of high volatility, with prices showing large fluctuations. Similarly, when the Bollinger Bands are widest, then it means that soon a less volatile period is going to arrive, and it is time to close the open deals. Note that Bollinger Bands do not give you the buy or sell signals, they just indicate the overbought, oversold or the current volatility in the prices. Next we will see how to create Bollinger Bands using Ggplot. Now let's continue our code from the previous slide. We have already downloaded the gold data, and created a data frame out of it. Now let's create a new data column in our data and generate a 20-day simple moving average. We are using the SMA command from the TTR package to create our SMA. Next we will create the upper and lower Bollinger Bands. For the upper band we use the SMA plus 2 standard deviations. And for the lower band we use the SMA minus 2 standard deviations. Note that the trick is to generate the rolling standard deviation for the same period which we used in SMA. So we used 20-day rolling standard deviation in our formula. To calculate the rolling standard deviation we have to use the RCPP roll package and use the roll_SD command. Finally, here is the command to create the chart which shows the daily closing prices of gold, and the 20-period Bollinger Band. The black line shows the daily closing prices of gold. The green line shows the 20-day simple moving average. The 2 red lines show the upper and the lower Bollinger Bands. Now that we have learned how to generate the Bollinger Band data and chart from scratch, let's see how the QuantMod package helps us to generate the charts. All you need is these lines of code. And it gives you many indicators like Bollinger Bands, CCI, momentum. You can choose which indicator you want to plot. I hope you found this information useful and practical. If you like this video, then please subscribe and like this video. See you in our next video.